Good evening, everyone. Taxation affects every citizen directly and indirectly. This session explains the major budget changes in income tax, relief for small taxpayers, foreign assets, disclosure norms, GST, customs in a simple and structured manner. Every budget answers two basic questions. Where does the money come from and where does it goes? Where money comes from? As we know, the money comes from purely from our taxes. This taxes contributes almost 40% with respect to income tax and corporate tax. Income tax higher than corporate tax. That is, individual contributes more than the corporates. Good. The next thing is that comes from GST and other indirect tax which contributes to 25%. Borrowings, it is there in our list. It contributes about 25% of the total expenditure. Other receipts from non-tax income and asset sales are minimal. The government runs on tax first, then on loan. Where the money goes? The money goes this manner. State share of tax takes 22%, interest on loan 20%, defense, subsidies and welfare measure accounts to 40%, and the balance goes to pension. The budget 26-27 shows revenue strong but debt dependent government, where nearly half of the spending is locked even before development begins. Next, we'll move on to India's financial performance. Just like a company's performance, we need to know how the India performs. Thing is that if you see the table, total receipts, both revenue and capital together is in the increasing trend. The numbers given are lakhs and crores, and the revenue deficit is also increasing. But the point is that the percentage of revenue deficit is decreasing. It is not decreasing drastically. It is decreasing in a phased manner. Then we'll move to fiscal deficit. What is this fiscal deficit? We would have heard of this fiscal deficit often. What does it mean? Thing is that the government needs to borrow 16,95,000 lakh crores. 16,95,000 lakh crores to meet the expenditure for the FY 26-27. So we have to borrow this year. For India, fiscal deficit is high but stable. What does it mean? The GDP continues to grow from 6.75% to 7%. It is a good indication. Further, we have to see other thing also, capital expenditure. Generally, it is said that whenever a country expenses on capex, in that case, they are looking at the long-term perspective instead of short-term perspective. What is this long-term perspective? They build roads, railways, ports, power, a digital infrastructure, now AI, and other data centers keeps on going. These things shows that we are looking upon the sustainability, long-term economic growth. Then we'll move on to the major thing, income tax. This year it is quite interesting. Why so? Because we have two acts. One is Income Tax Act 2025 and Income Tax Act 1961. This Income Tax Act 2025, it replaces 1961. But the case is that for all the notices, orders, whatever has been issued for the period prior to FY 25-26 and earlier, only Income Tax Act 1961 prevails. From financial year 26-27 onwards, Income Tax Act 2025 rules. That means we have to go with two acts right now till all your assessment completes. The golden rule is that assessment year decides a law, not the date of notice, order or appeal. Taxable event is the earning of income. Law applicable is the law in force when income arises. This one we need to keep remember. It is not that 2025 goes to rule ever. 1961 will go on till the year 26-27 starts. Then this Income Tax Act 2025 has been brought with the thing in that it to reduce the complexity, provision driven 1961. But the case is that we need to wait and watch. It has been streamlined in that manner. But as the year goes alone, we know how far Act 2025 supports our complexities. Next, we'll move on to amendments to business, profession, capital gain and income from other sources. This will be dealt by Sasi Priya. Very good evening, everyone. I'm Sasi Priya, and I will be presenting the key amendments introduced in the recent budget 2026 relating to the heads of income, including profit and gains of business or profession, capital gains, and income from other sources. These amendments are significant as they directly impact the business taxation and other investment transactions. Let us begin with the amendment relating to deduction of employee contribution to welfare funds. Previously, employers can claim the tax deduction of employee contributions like PF, ESI, and other welfare funds, which are generally deducted from the salaries of employees only if those have been deposited to the respective funds on or before the due date as mentioned in that respective law. Say, for example, for Provident Fund, the due date for depositing the amount would be 15th of next month. If deposited late, then the deduction is not allowed even if the contributions are deducted from the pocket of the employees. Now, this amendment provides timely relaxation with respect to depositing the amounts to the respective funds, which means if the employee contributions are deposited on or before the due date of filing the income tax return for that particular year, then the deduction is allowed. And so the employers will not lose the deduction in that particular case. Next, we will now move on to the amendment relating to PGBP on presumptive basis. Under the prevailing provisions, presumptive taxation is available to resident individuals, HUFs, firms other than LLPs engaged in eligible businesses subject to the turnover limits of 2 crore or 3 crore where cash receipts do not exceed 5% of the total turnover or gross receipts. Income is computed on a presumptive basis at 6% of digital receipts and 8% of cash receipts or on the actual profit declared, whichever is higher. However, to qualify as an eligible assessee, the person should not have claimed certain specified deductions, including deductions available to newly established units in special economic zones. Thus, if a taxpayer claimed a special economic zone deduction, they were not eligible to opt for presumptive taxation scheme. This proposed amendment omits this restrictive condition relating to special economic zone deduction. As a result, the assessees who claim deduction for newly established special economic zone units can now also opt for presumptive taxation, provided they satisfy the turnover limits of 2 crore or 3 crore, subject to that 5% cash condition and other eligibility criteria. The impact of this amendment is that it removes the earlier compulsion to choose between the special economic zone benefits and simplified presumptive taxation. Okay, we shall now proceed to discuss the amendments pertaining to buyback of shares. From 1st April 2026, the Act introduces an additional tax burden on promoters when a company buys back its own shares or other specified securities. Under the existing provisions, when a shareholder sells shares to the company in a buyback, the difference between the buyback consideration and the actual cost of acquisition is taxed as capital gains, either short-term or long-term as applicable. However, under the proposed amendment, the promoters will not only pay the normal capital gain tax, but also an additional tax on the amount of the capital gain arises from that particular buyback. The additional tax applies specifically to promoters and varies depending on whether the promoter is a domestic company or any other entity such as foreign entity and whether the gain is a short term or long term. Say, for example, in case of listed company, a domestic promoter earning long-term capital gains will pay 10% normal long-term capital gain tax plus an additional of 9.5% tax on the same gain. Thus, the total tax liability increases significantly compared to the earlier provisions. Here, the term promoter is defined with reference to SEBI regulations in case of listed companies, and for unlisted, it includes persons defined as promoters under the Companies Act 2013 or any other person holding more than 10% of shares directly or indirectly in that particular company. The objective of this amendment is mainly to curb the use of buyback of shares as a tax-efficient exit mechanism for promoters and to align the buyback transactions more strictly for controlling the shareholders. We shall now take up the amendments with respect to transfers for the purpose of capital gains. Under the existing provisions, certain transactions are not regarded as transfer for the purpose of capital gains, out of which redemption of sovereign gold bonds issued by the RBI under the Sovereign Gold Bond Scheme 2015, when redeemed by an individual, is not treated as a transfer. Consequently, no capital gain arises on such redemption. However, this benefit is presently restricted only to the sovereign gold bond schemes issued under 2015 scheme and applies specifically to individuals, which may create ambiguity if new future. The proposed amendment extends this benefit to the Sovereign Gold Bond Scheme 2015 as well as any subsequent sovereign gold bond schemes notified by the government, subject to the condition that if the individual has held the bond from the date of original issue till the date of maturity. Accordingly, the redemption of such bonds will continue to not treated as transfer and no capital gains will arise. This amendment ensures continuity of exemption and removes the need for fresh legislative changes whenever a new sovereign gold bond scheme is launched. So far, we have completed the discussion on amendments concerning the capital gains and business income. Now let us take up related to deductions. Under the existing provisions, while computing income under the head income from other sources, a deduction is allowed for a reasonable commission or remuneration paid to a banker or any other person for realizing dividends or interest on securities on behalf of the assessee. However, as per the proposed amendment effective from 1st April 2026, this clause has been substituted to restrict the deduction only to the commission paid for realizing the interest on securities. Consequently, no deduction will be allowed for commission or expenses incurred for realizing the dividend income. Another amendment is also related to dividend income. From the assessment year 27-28 onwards, no deduction will be allowed against any dividend income or income from specified mutual funds or units of specified companies. Earlier, while certain types of dividend income did not permit any deduction, other dividend income and specified unit income, including both specified mutual fund and UTI units, were eligible for a limited deduction of interest expense up to 20% of the gross income. With this amendment, even this restricted interest deduction has been removed, and therefore all such dividend and unit income will now be taxed on a gross basis without allowing any expenditure deduction. In conclusion, the final budget 2026 introduces significant changes impacting business income, capital gains, and income from other sources, tightening certain deductions while providing targeting relief in specific areas. With this, I handed over the session to Ananthalakshmi ma'am, who will cover the amendments concerning exemptions and deductions. Now we will see exemptions and deductions given in this budget. First, exemptions and tax relief on TDS on interest under Motor Vehicles Act 1988. We know the compensation received from Motor Vehicles Act is exempt. This compensation is given for death, permanent disability, bodily injury. Compensation was exempt. So far, interest on compensation was not exempt. We know generally we don't receive the compensation on time. So, interest is also given. But that interest was taxed so far. Now they have given a relaxation that interest is not taxed here henceforth. Furthermore, as the interest is exempt, there is no question of TDS. So, relevant TDS also is removed. Currently, once your interest exceeds 50,000, interest TDS is applicable. That thing also removed right now. Next, we'll move on to income on compulsory acquisition of land from land under the Act, right to fair compensation and transparency. What is this? We get compulsory acquisition on the land acquired by the government. Here, the case is that Income Tax Act says one thing and the particular right to Fair Compensation Act says something else. The thing is that the Right to Compensation Act has an upper hand, but the income tax has ignored that so far. What does that means? The thing is that whenever we receive compensation from this RFCT Act, thing is there is no income tax shall be levied. No income tax shall be levied. But as per income tax, so far only agricultural land, on sale of agricultural land, we got exemption. That is also with respect to Hindu and individual and Hindu undivided family. Moreover, the circular was given. Why the circular has been given? Because the Income Tax Act and RFCT Acts were not uniform. What RFCT Act says that there must be some, there will not be any tax, but income tax was imposed. To that, circular was issued stating that any compensation received from this right to Fair Compensation and Transparency Act is exempt and it shall not be taxable under income tax, even in absence of specific exemption provision given in the Income Tax Act. Now, to remove all this ambiguity, what they have done is that they have said any income arising in respect of an award or arrangement, the condition is that the compulsory acquisition of land. So, whenever there is a compulsory acquisition of land, and the act which rules the compulsory acquisition requires to be addressed, because all act doesn't give this benefit. Suppose there is a compulsory acquisition by national highways, no such benefit is given. Similarly, metro, for developing metro, some acquisition happens. In that case also complete exemption is not given. Now we will see certain cases where the agricultural land acquired by state government, under which act always matters here. If it is RFCT Act, then in that case, agricultural land, entire amount is exempt. Principal component, solatium and additional compensation, entire amount what we receive is exempt. Even in case of non-agricultural land, it is exempt for HUF and individual. But one thing to be noted, only thing is that whenever there is a compulsory acquisition, it is exempt. But in case of private agreement, arrangement, in that case it is not exempt, it will be taxed like other scenarios. Next, we will move on to some exemption for disability pension, armed forces and paramedical personnel. Okay. The prevailing provision is that disabled pension is paid to members of armed forces who are invalidated out of service. That means forced discharge from services. Okay. And that needs to be attributable or aggravated by military, naval and air force services. This disability pension comprises two components. One is service element and other thing is disability element. What is this service element? Suppose a person has met with an accident in the year age 30, then till 28 years, he will be given one compensation under the category service element. Another thing, for his disability, what has caused during his service, for that also he is given compensation. This exemption was misused. What is that thing? Even in case of superannuation, voluntary retirement, the people were obtaining exemption under this category. To avoid that, what the amendment has made is that disability pension, both service element and disability element, shall be fully exempted, provided where the individual, he should be a member of the armed force. Now paramedical forces is also covered, and the individual has been invalidated out of service, that is, he is moved because of his disability. This invalidation is due to or attributable or aggravated by service condition. For other than that, no such exemption is available. They have made it clear this time. Next, we know very well this government is encouraging foreign investments. We know half late the FDI has, most of the foreign companies or investors are moving out of India to attract them, to attract in the form of investment directly in the shares or in the form of manufacturing. The government has given many exemptions. In this budget, we can see multiple exemptions to foreign companies and non-resident. One among that is that we know AI and data centers are the talk of the town. In line with that, to encourage foreign companies to invest in data centers to support AI and data digital infrastructure and position India as a global data processing hub. Thing is, the exemption has been given to foreign company for any income accruing or arising or deemed to accrue or arise in India by way of procuring data center services from a specified data center. We'll explain this by way of an example. And we'll just take a case of a company which is in US. It procures cloud compute and storage. Here, every data center is not permissible only from a notified Indian data center. That means this US company needs to procure cloud compute and data storage only from notified data center. If the company procures, that is an expense, then it uses such infrastructure to deliver AI and cloud services. To whom it can do? It can do to global customers or it can do to Indian customers. If it is global customers, services delivered outside India, expenses incurred via India is utilized and the concerned company earns income. It is stated that that income is exempt from taxation, provided there is no PE or no other Indian source income. Coming to Indian customers, if suppose this Alpha AI wants to sell to Indian customers, then he has two options. What is that? He can bill directly. That is, Alpha Inc. can bill directly. In that case, he can't get tax benefit. But he has to choose a route. This billing must be through Indian seller. In that case, he can get the tax benefit. And this tax benefit is available till 31st March 2047. This is long term. We are in 2026. This benefit has been given to those people till 31st March 2047. What does it indicate? That helps us to them to plan for long term level, 21 years. This signals stability. Then we'll move to only one condition is that they have to procure data services from notified, and in case they want to do domestic selling, they have to choose Indian reseller entity. Then we'll move on to, again, I'll be talking about only the foreign company. See here, what is happening is that the foreign company, if it is supplying capital equipment to electronic goods manufactured in bonded customs area, what here does nothing comes free, everything comes as a condition. Okay, if Apple wants to sell some capital equipment for producing electronic goods and those goods needs to be given back to them, in that case, what is stated is that at the whatever income they earn out of this capital equipment or tooling, in that case, whatever income they earn out of this capital goods equipment, they will be exempt. This also we will see with the case study. Here, if you see, Electrotech Inc. is a Japan-based company. What is that they do? They supply specialized semiconductor fabricated tools, that is capital equipment, to whom? To a company in India. In Indian India Fab Electronic Private Limited, provided it must be in customs bonded warehouse area. And what does it do? It can use the tools to manufacture smartphones exclusively for Electrotech Inc. That means after manufacturing, this goods needs to be given to Electrotech Inc. So in that case, whatever billing Electrotech bills India Fab and the income earned by Electrotech in Japan is exempt from tax. Then again, this is also with respect to foreign company. We know presumptive taxation is there. Even though presumptive taxation is there, for certain cases, MAT is also applicable. Now, what they have done is that certain foreign companies are already excluded from MAT. But the case is that to that list, they have added two more services. What are the business thing is that business of operating cruise ship and business of providing service or technology for setting up electronic manufacturing facility in India to a resident company. In this two category, that is cruise ship. If a foreign company is doing the operation of cruise ship or providing service or technology services, for the purpose is that manufacturing, electronic manufacturing facility. If they are doing these services, they can stick on to presumptive taxation. That means presumptive taxation is that instead of having detailed books and records, you have to pay tax on the receipt amount what you receive, a percentage. For example, the cruise ship here in this case, they have to pay 7.5%. And based on that, the deemed income is arrived. What could be the deemed income in this particular case is that 78 lakhs 75,000. In spite of the book profit, even the book profit is 1 crore. In that case, these people can limit their taxation to 78 lakh 50,000. If they pay tax on that, that will be helpful. So that is what now MAT is removed for these two business and they can stick on only 2% rate. We move on to the next exemption. Okay, we know offshore banking unit and units of IFC. Every budget has some exemptions or some deductions, some benefit is given without fail. In this year also, some more benefit is given for offshore banking units and units of IFC. Why so? There could be some reason for doing that, right? The reason is that this unit helps to receive foreign funds at lower cost. So India gets fund and at lower cost. So to encourage investment by people outside India, they give so many benefits. In that case, one among it is, this offshore banking unit right now, its tax exemption period is 10 years. Now from 10 years, they have increased to 20 years. Again, for IFC units, exemption period is 10 years out of 15 years. Now again, they have increased this period 20 years out of 25 years. They enjoy the benefit furthermore. Now we will move on to trust, PF and security transaction tax amendments. Trust. What is a trust? Here changes is that merger. We know the company merges. Two company can merge. Similarly, trust also can merge. Why is that it can happen? Sometimes there could not be a proper trustee to take up the trust, or for merge synergy benefit, like company synergy benefit, trust also will have synergy benefit. For that case also, two trust can merge. What has happened is that in the Income Tax Act 2025 by mistake, they have given that when a two trust merge with same or similar objective, it could be taxed. It has been wrongly drafted. To correct that, they have given this proposal. Then now what happened is that whenever two NPO, that is trust, merges, in that case, they can get benefit from this accredited income. We'll explain this. What is this accredited income? Okay. While doing merger, please ensure, we trustees kindly ensure that whenever you do merger, merge trust with the registered non-profit organization. That is one thing required. Second, if you are even if you merge with the trust with the same and similar objectives, try to ensure all the conditions are fulfilled. And the third category is that if you are merging, kindly ensure they do only same or similar objective. What if not? If I merge with a trust which is not similar, what will happen? Then we use the word accredited income. What does that mean? The fair value of both the trust together will be considered, less its liability will be considered as your income. So what is the value of both the trust, less its liabilities will be considered as income and it is taxed. That means you are coming out of the trust ambit. In that manner, it is taxed. Accredited income, tax is not less. So what will be maximum marginal rate? It will be taxed. What is this maximum marginal rate? 30% is the maximum plus surcharge 25% plus cess. So it will be taxed higher. So whenever there is a merger of trust, act with caution. Then people wonder, this year salary they haven't given any benefits, right? Generally salary or tax slabs, there will be some changes. But this year there is no direct benefit. Only by way of provident fund they have given benefits. What is that? We will understand. The thing is that with respect to provident fund, there are certain conditions a provident fund must abide. What is that? For the employer contribution cannot exceed employee's contribution. That means employer contribution cannot be 6 lakhs when your employee contribution is 4 lakhs. What will happen? The recognition of the provident fund can be taken off. Now they have removed that. So what does it mean? Now the employer can contribute more than the employee. That means if employee's contribution is 4 lakh, employer can contribute to 6 lakh. Now no tax will be there. But one condition is that the maximum contribution could be 7,50,000. Cap that still remains. Okay, this is one welcome approach. And again, here what was talked is about the quantum amount threshold limit has been given. Next, what is said is that now again if you see, this is similar to earlier one. employer can contribute 12% from your salary as PF. Now, employee can contribute 12%, employer can contribute more. So, which was not earlier permissible, now employer can contribute even 50%, 20% as per the company's norms. Earlier, if it crosses over and above 12% will be taxed. Now it is not the case, but only one limit to be seen is that it will be taxed only when the total contribution exceeds 7.5 lakhs. Right. Next, we'll move on to the next point. This one is that the board of Provident Fund has the power to make rule that we know. What is the thing happened is that for PF purpose, if the employer, there is a distinction. What is the distinction? Common employee and the employee who is a promoter. This power of the board is that they can vary the right of the employee, general employee and employee cum shareholder. In that case, they can restrict. Why such restriction? Because thing is that the promoter employee should not take away the fund of the company in the form of provident fund. To restrict that, the power was given to the board to ensure that they have less power with respect to PF. Such disparity has been removed. Now, employee, ordinary employee and the director shareholder employee are treated par. There is no specific restriction. They are treated, that means employee, if he is a shareholder, employee not as a shareholder, they have given equal rights. Then we will move on to next important thing, security transaction tax. On 1st February, the market has gone down. One of the primary reasons for such downfall is that there was an increase in security transaction. It is not security transaction has not been increased for all securities, only for futures and options. Why so? Thing is that the government feels that the securities and options are gambling. It may result in positive, it may result in negative. But most of the cases, this options and futures has resulted in the negative. And the person who are investing are autowalas, small roadside vendors. In spite of earning, they are losing a lot. So to curb that, right now what they have done as a small step, we don't know, this will not stop, I don't say. But the thing is that this could limit their transaction with respect to options and futures. Right now what the government has done is that from 0.1% with respect to option and securities, they have increased to 0.15 security transaction needs to be discharged when they are doing options in sale of options in securities. And respect to futures also, slight increment is there from 0.02% to 0.05%. These are the changes with respect to trust security transaction. Next, now we will move on to TDS and TCS amendments. Will be taken by Renfred.
I will be discussing the recent amendments with regard to TDS and TCS. Let us begin with TDS on transfer of immovable property. Generally, on transfer, any person who is required to deduct TDS shall also be required to obtain TAN. However, obtaining TAN can be a lengthy process. The Act provides a relaxation that if property is transferred by a resident seller, tax deduction can be carried out through a PAN-based mechanism by filing Form 26Q. However, the relaxation is not available to cases where the seller is a non-resident. To address this issue, in the proposed amendment, the relaxation shall now be extended even to cases where the seller is a non-resident. Okay, let us now move to TDS on supply of manpower services. TDS is generally applied at 1% or 2% in case of contractual services and 2% or 10% in case of professional or technical services, as the case may be, and where payment is made by the individual or HUF for specified services like contractual or professional or technical services which are not covered earlier, or commission or brokerage services, TDS is deducted at the rate of 2%. Earlier, the main ambiguity was around supply of manpower. It was unclear whether the supply of manpower is to be treated as contractual or professional or technical services. The proposed amendment clarifies that the supply of manpower is to be treated as work, and the supply of manpower, if skill, technical or professional is nature, the TDS will be deducted at the applicable rate based on its nature. Let us understand this with an example. X Limiter hires a firm to provide security services with a monthly payment of 50,000. Earlier, there was an ambiguity around supply of manpower, so the same is treated as professional services and the TDS is applied at the rate of 10% being 50,000. However, after amendment, the supply of manpower is deemed as work. The TDS shall be deducted at the rate of 2% as the contractor is not an individual or an HUF. Okay, let's go on to example number 3, where Mr. A, an individual, engages a manpower agency for office assistant with a payment of 1,50,000. Earlier, there was a confusion whether it is to be professional services or technical services, and some were deducting TDS at the rate of 10%. However, post amendment, it is now treated as contractual services and TDS is deducted at 2% being 3,000. Okay, let us also understand example number 4. Suppose a company hires a firm to provide 10 data entry operators and a software designers. In this case, there are two separate components. One is manpower services being data entry operators and the professional services being software designer. Accordingly, TDS shall be deducted at the rate of 1% or 2% on the manpower component and the 10% on the technical component relating to software designer. Okay, now let us move on to the rationalization of TCS rate. Under the existing provisions, multiple TCS rates are applied to different category of transactions. To simplify the compliance and to provide relief, the amendment proposes uniform rate. Okay, let's go deep on that. In case of sale of alcohol for human consumption and sale of scrap, including minerals, the earliest TCS rate of 1% is proposed to be increased to 2%. However, in case of sale of tender leaves, the earlier higher rate of 5% is proposed to be reduced to 2%, thereby ensuring uniformity. For remittance under liberalized remittance scheme exceeding 10 lakhs for education or medical purposes, TCS is currently applicable at 5% under the existing provision, and the proposed amendment seeks to reduce the rate to 2%. In other remittance, the higher rate of 20% remains unchanged. In case of sale of overseas tour packages, which include expenses such as travel, boarding, and other related expenditure, TCS is currently applicable at 5% for amount up to 10 lakh rupees and 20% for amount exceeding 10 lakh rupees. However, the rate is proposed to be reduced to 2% without any threshold limit. Thank you. The next section will be taken up by senior partner.
Good evening. The next part, we come to the compliance part and as well as the consequences for not complying. So, section 263 talks about return filing, due dates for return filing. Earlier it was 139. Section 139 was referred for due date for filing return for various categories of assessees. The first category of assessee is companies where transfer pricing applies. The due date is 30th November. In case of companies and tax audit cases where transfer pricing does not apply, the due date is 31st of October. In case of non-business other than tax audit cases, the due date has been given as 31st August. For any other assessees, the due date is 31st July. So the assessee, all other assessee include salaries, so that date has not been changed. But for business people who are non-tax audits, the date is 31st August. They have also revised the section 263(5). They have revised the date from 9 months to 12 months to file a revised return. So earlier it was 9 months. Now they have moved it to 12 months. The next two amendments here is, earlier while filing an updated return, you cannot file a loss return. Now you can file a loss return in an updated scenario provided two conditions are satisfied. One, the original return loss return was filed within the due date, and two, the loss has been reduced. Only if you reduce the loss or if income arises, then you are allowed to file the updated return in case of a loss scenario. Then one more thing they have introduced is, usually earlier section 147 pertains to income escaping assessments. So now it is section, and they issue notice under section 148. Now they have, the revised section is 280. So as per 280, if they issue a notice for you to file an updated return, then that is allowed now to file a return. Based on that, you can file an updated return. Next section. Next, we move on to section 267, tax on updated return. So this updated return concept came last year before years. There are 4 years for which you can file updated returns. So within any revised return, beyond the revised return and the related return time and falling within 12 months, then the rate of tax is 25%. So if it is 12 months, above 12 months and below 24 months, it's 50%. Above 24 and below 36 is 60%. And above 36 and below 48 is 70%. So the amendment here is, when a notice is issued for section 280 to file an updated return, in which case the assessee has to pay an additional 10% depending upon the year that he has to file. For example, if he has to file the return which is beyond 24 months and less than 36 months, then normally you will pay 60%. But in such scenarios, you will have to pay another 10%, so which comes to 70%. So for all updated returns, accordingly, whether it's 12, 24, 36 or that period, additional 10% will follow. Next is on MAT credit. So this MAT credit, we have to understand this MAT credit clearly, whether you want to continue with the old regime or you want to move to the new regime. So if you want to continue if you want to continue with the old regime, there is no MAT credit. Future, you will never get MAT credit. The rate earlier, first let me explain what is MAT credit. So normally for a company, it is taxed on normal rates or minimum alternate tax rates. If the normal tax on normal tax is higher, then they pay as per normal tax. If the normal tax is lower than MAT, then they pay as per MAT, which is at 15%, and it can be carried forward for 15 years to be set off subsequently when you have a reverse situation. That is, when your tax is higher and your MAT is lower, to that extent the difference you can adjust. That is the existing law. Now, still if you want to continue the old law, your MAT tax from 15% becomes 14%. So that is the final tax. You will not get credit, and no credit which was accumulated earlier can be carried forward. Then why should we stick on to this old regime is, there are scenarios where you can claim additional depreciation. In case you claim additional depreciation, your normal tax will be lower, in which case you pay MAT at the rate of 14% and you're done. So normally your better effective rate is here. That is a scenario where you can stick to the old regime. But in case of new regime, so whatever tax accumulated MAT credit up to 31/3/2026 can be carried forward and adjusted over a period of 15 years. But the restriction is, every year there is a 25% restriction on the tax. So there is no MAT in the new thing. So if you have a tax liability of 20 crores, so maximum that you can avail is 25% on that, which will be 5 crores. So that is what you can avail. Likewise, every year you can avail 25% until you exhaust your accumulated credit, until you exhaust it. In case of foreign companies, there is no such restriction. In case of foreign companies, this 25% restriction is not there. For example, the normal liability in case of foreign company is 20 crores. The MAT is 14 crores. So in case of a domestic company, on 20, if you apply 25%, it is only 5 crores. But whereas if for a foreign company, they can avail the entire difference. Whatever is available, they can avail the entire difference which they have given for a foreign company. But for a domestic company, it is restricted to 25%. So this is the difference between old regime and new regime. So now this is an important amendment that they have made, non-invalidation of document due to DIN omission. So DIN is nothing but it's a document identification number. So any order, any notice that you receive from the department, it will come with a DIN. So there may be certain situations where this DIN is not mentioned in an order, but even though the order is on merits, it is fine. Even though the order is on merits, it's fine. So people have challenged based on technical grounds, stating that you have not mentioned the DIN, therefore this particular order does not stand valid on a technical ground. So to avoid such litigations which is ongoing, there are a lot of litigations which are ongoing and pending in courts based on this technical ground. So they have introduced this amendment stating that if the DIN is improperly mentioned or if the DIN is not mentioned, if they can trace this DIN to any document, then that is enough. So in such situations, if your case is on merit basis, you can still survive. And if you are only fighting on a technical ground, I don't think you will be able to survive this case because of this amendment. So if any case is pending in the courts, it will come back to the department. So only you can fight against. If you have a merit, you can fight. If it's only on technical ground, mostly it will be an issue for the assessee. Next. So section 286 is the time limit for completion of assessment in transfer pricing cases. Earlier there was ambiguity and there was no clarity for legislative clarity in terms of completing transfer pricing assessment. Now they have extended by 12 months for assessment or reassessment. They have extended by 12 months. So the next is section 295. It is the assessment for block assessment for a third person. See, for example, when a search is initiated, say for example X, so when they go for on X's premises, then there may be connected persons for whom, because of they went to the X premises, they may have a connected, that is called a third person. So prior to the amendment, the prevailing situation was they calculate, they take the assessment for 6 years, 6 block assessments they take for A as well as the concerned person. The concerned third person, if he does not have any issue even other years, suppose his issue pertains to 1 year or 2 years also, still they will open all the 6 assessment years and assess for both, for A who has been searched as well as the third person who has been searched. So it was a complete thing for both of you. The amendment, what the amendment has been come now is, in case of a third person, if they identify that income is only representing a particular year, then if you open up that one particular year, that is enough, and you can assess that one particular year instead of opening all the 6 years. Only for the searched person, they will open up all the 6 years, but for a third person, they will open up only years that are connected issue. Suppose you have 1 year, they will open 1 year. If you have 2 years, they will open up for 2 years and complete the assessment. It need not be completed for all the 6 years. That's the amendment for this. Next is the timeline for completing such assessment cases. So there are a lot of issues earlier. See, earlier when they issue the search warrants, see, the dates were based on last search authorization. See, for example, if a search authorization was issued on May 15th, then the assessment will be completed 12 months from the end of the quarter in which the authorization was issued. So for March 15th, the quarter is 30th June. So from 30th June, it is 12 months to complete the assessment. That is how it was to happen. In this scenario, there were a lot of groups which have been assessed. So connected groups were being assessed. So each one had a different last search authorization dates, due to which they had issues in completing the assessment. Some search assessment had enough time. Some search assessments had lesser time. Because of this uniformity, they had lesser time. So to avoid all these complications, what they have introduced is, they have extended the time of block assessment from 12 months to 18 months. And the date is when the search is initiated. They go for A, they have initiated on 10th April 2026. Then it is 18 months from there. For B, when it is initiated on 15th May, then it is 18 months from there, which is 15th November. So there is a clear clarity on when you should complete the block assessment, and they will have time for each cases. So they have clearly mentioned here that this is how it has to be addressed. This is another issue which has been pending in courts for determination that, see, for transfer pricing case, that 60 days within which the limitation period, before the limitation period, the order needs to be passed. So there are a lot of cases which are pending in courts on determination of the limitation period for 60 days. So this is the issue here. The next table, in the table we can see. So if it is a non-leap year, when 31st March is the last date for assessment, TP order has to be passed by 30th January. In case of leap year, then 31st March means 31st January TP order has to be passed. For other years, 31st December, that means 1st November, the TP order has to be passed. So there is a clear clarity. So there is no ambiguity in dates. Because of this, they were technically fighting because this is a retrospective amendment. And because of this, they have been fighting that all will come to a standstill. It will be closed. The next part is penalty and prosecution. Again, this is because of not complying with certain things. This is the consequences that we are facing. So now this is an important thing that they are now trying to capture more data in terms of cryptocurrency. This section 446 read with 509. So 509 section is they have put a responsibility for the crypto exchanges and platforms. They have to report all the transactions on a regular time, regular interval, and accurately. This was brought in 2025, but without a penalty, or there was no such disclosure in terms of the agency reporting entity. Now, to make this more compliant, so they added penalty on the reporting entity, that is a cryptocurrency exchange or platform. If they don't furnish the dates within the due date, then 200 rupees per day penalty till when they furnish the details. Inaccurate furnishing is 50,000 penalty they have put, but they will have some time to cure that. If they cure that thing, then they will not have this penalty. Otherwise, they will have this penalty. But now, why they are targeting an reporting agency instead of an individual here? So now they are trying to collect the data, because this is the area where even the department finds it difficult to collate information or track data on people who are investing in crypto and not showing in their accounts. So I think this area will be focused going forward by the department. So it is always advisable to reflect it properly and take appropriate advice. And if you are really interested in investing, take appropriate advice and invest properly to avoid such consequences. This is an initial stage. Going forward, these consequences are going to be even more. So it is better you plan yourself accordingly in case you want to do investments. Do not take any wrong advices and land up in such confusions later on. The next section is, again, it is based on unexplained credits, unexplained investments, assets, expenditures. So for all these things, they've actually tweaked a little bit, but then if you see that effectively the tax rate is higher. So if you see this example, it says earlier whenever there was an unexplained credits or unexplained investment assets, it was taxed at 60% tax rate. And then there was a surcharge of 15%. Apart from cess, education cess 4%, and the penalty was on a general 10% penalty. So if you total up this, the effective rate was 85%. Suppose you had like 10 lakhs of income that has come under this category, almost 8.5 lakhs would have gone by way of taxes. Now what they have done is they have changed the base rate from 60 to 30%. They have also removed the surcharge from 15% to 0, but they have increased the penalty to 200%. So if you see the 200% penalty, now the effective rate works out to 93.6%. So which is even higher, though the base rate has been reduced, but the penalty has been brought into uniform penalty, because earlier this misreporting was under this thing. Now this underreporting with regard to misreporting also has been clubbed with this section 439.11. They have clubbed it. So it is higher. One immunity you have here is if you want to get away with this, you can pay 120% of the tax as penalty. Thereby, you get immunity and the case gets closed. So, which effectively the tax rate works out to 67%. That means for 10 lakhs of disclosure or 1 crore of disclosure, you pay 67 lakhs and you're away. But if they charge 200%, then you pay for 1 crore 93 lakhs. You pay nothing. It is almost like you pay the entire tax in such scenarios. So this again is a compliance issue, and consequence is such that So if you are able to clearly record, plan, and not have such unexplained credits, unexplained expenditures, so before incurring such things, if you can plan and then do accordingly such activities, then these issues will not come up for you in future. Otherwise, these are the consequences that you will need to face. So when it comes to section 279, next there are certain sanctions and compounding procedures, prosecutions. So they have clearly told that certain people they do not have the power to do this. That is, now certain cases are being handled by faceless assessment units. So those assessing officers do not have powers to do any sanctions or compounding. It will be only done by the jurisdictional assessing officers, not by the faceless team or assessment units. So that they have clearly clarified that for sanctions and compounding of prosecutions, they are not the officers to assessing AO. They are not the AO for this particular activity. Next. So this is actually a transition provision. This is actually a transition provision. So they have since it was a transitional benefit available to cess thing, they have removed this reference in section 270. So this has not much impact. Now the bigger part is that the foreign asset, this again is a consequence of not complying. So foreign assets and of small taxpayer disclosure scheme is a scheme that they are bringing in, which it is a voluntary amnesty scheme that is provided to the taxpayers who have not shown their old foreign income or foreign assets, who have not disclosed earlier. Now they have given a chance. They are going to give a chance, which is going to come up in the next 6 months, anytime in the next 6 months. After April, they will give this. And then before that, you can avail this opportunity. But who can avail this opportunity? Who can avail this opportunity is those who have income and assets outside India and not disclosed in their return, and their aggregate value does not exceed 1 crore. So, and there are no prevention of money laundering proceedings, or the assessment has been completed under Black Money Act. So, if these no Black Money Act assessment, then they are eligible for this. So, what is the consequences? If they are eligible, they pay 30% of tax and equal penalty, 100% penalty. So, with that, they are away from all immunity, any prosecution under Black Money Act. They will get the leisure. There is one more scenario, is category 2. There is one more scenario where you have offered the income completely, but you have not offered the asset. If the value is less than or equal to 5 crores, then you will pay a fee of 1 lakh in such scenarios. But if you are above this category, then you are in deep trouble. So you will have to pay a tax of 30%, penalty can go up to 300%, and all prosecutions can be done. Probably there may be a way out. Maybe you can, if you have not offered the foreign tax right now, foreign income to tax right now, you can do an updated return, file this tax, and then offer this income before the scheme comes into place. So maybe that is an option available right now. Probably we can try in case of people who have not shown their thing. So the next part is on GST. Shreeyans will present the GST and customs. Thank you.
Good evening, everyone. Today I will briefly walk you through the key GST and custom changes proposed in Budget 26-27. I will focus on what has changed conceptually, why it's matter, and how it's impact. One of the most important GST changes in this budget relates to intermediary service provided to overseas clients. Earlier, GST law treated intermediate service as a special category. Even when the service recipient was outside India, the law fixed the place of supply as a location of intermediary, that is, location of supplier in India. This meant GST was payable in India despite the service being consumed outside India. The budget removes this special rule. As a result, intermediary service will now follow the general place of supply principle, which is based on the location of recipient. Let me explain this amendment using a practical scenario. We have ABC Private Limited located in India. ABC Private Limited is not supplying goods or service on its own account. It is simply arranging and facilitating a transaction between two independent foreign parties for XYZ Incorporation in USA. For this facilitation service, ABC receives a commission of $10,000 from XYZ Incorporation, which is a foreign client. Under that old provision, the place of supply was considered to be the location of supply, that is, India. Because the place of supply was in India, GST was payable in India. Even though the client was outside India and payment was received in foreign currency, the service was not treated as export. Therefore, export benefits like zero rating and refund were denied. The GST burden fell on Indian intermediary. Due to this amendment, the place of supply is the location of recipient, that is USA. Since the place of supply is outside India, the service qualifies as export of service. No GST is payable in India, export benefits are available, the Indian intermediary does not bear GST burden. In simple terms, GST will now look at where the customer is, not where the intermediary is located. The next change deals with how GST value is determined when prices are revised after supply. Under the earlier GST framework, valuation was driven largely by what was agreed at the time of supply. Any price reductions or discounts that arose after the supply due to business negotiations, performance considerations, or commercial adjustments was not recognized for GST purpose unless it was pre-agreed. This created a mismatch between commercial reality and tax liability. Business ended up paying GST on value higher than what they ultimately received. The budget addresses this gap. The amendment provision allows wholesale discount to be recognized for GST valuation, subject to procedural safeguards such as issuance of credit note and reversal of proportionate input tax credit by the recipient. Let me now explain how the amendment practically changes the GST calculation. The original taxable value will be 10 lakh. GST will attract at 18%, that is 1,80,000. Therefore, the total invoice will be 11,80,000. Later, the supplier gives a wholesale discount, that is for 1 lakh. Earlier, wholesale discount were allowed only if there was a pre-agreed agreement. In this case, since the discount was not pre-agreed, GST has to be paid on 10 lakh. Even though the supplier actually received only the service for 9 lakh, they need to pay on a total amount. GST will be paid remain 1,80,000. No GST amendments adjustments allowed. Credit note issued only for accounting purposes. Taxable value remained for 10 lakh. So GST was paid on the original value, not on the final value. After amendment, now pre-agreement required is totally removed. Supplier can issue a credit note. Taxable can be revised. Therefore, the revised taxable value will be 9 lakh, not 10 lakh. GST will be paid on 9 lakh, not on 10 lakh. GST attracts will be reduced to an 18,000. The recipient must reverse ITC of rupees 18,000. In essence, GST now taxes the real economic value of transactions. Next, effects on the credit note definition due to amendment. Earlier, GST law allowed issuance of credit notes, but it was not explicitly clear where such credit notes could be relied upon. Revise the taxable value of supply for GST purpose. Because valuation provisions and credit note provisions operated independently, tax authorities often questions GST reduction arise from post-supply adjustments. The amendment addresses this structural gap by expressing aligning the credit note provisions with valuation sections. This confirms that credit note are an integral part of the GST valuation mechanism and not merely for an accounting formality. Let me explain this with an simple example transactions between two companies. Original transaction between PQR Limited sells a machinery to LMN Limited. Value of the machinery will be 5 lakh. GST attracts 18%, that is 90,000. The total invoice value will be 5,90,000. At this stage, PQR Limited will pay 90,000 as a GST to the government. LMN Limited claims 90,000 as a ITC. Later, the quality issues is identified. PQR Limited agrees to reduce the price of 50,000 by issuing a credit note. Now, the actual value of the machinery becomes 4,50,000 instead of 5 lakh. GST on 4,50,000 will be attracted at 18%, that is 81,000. So GST needs to reduce by 9,000. After issuing the credit note, PQR Limited will reduce its GST liability by 9,000. LMN Limited reverse its ITC by 9,000. The amendment ensures that when the transaction value changes, the GST liability also changes accordingly. Next, another key reform is in the refund mechanism, especially for inverted duty structures. Earlier, provisional refunds were mainly available for exports, while inverted duty structure refunds required full verification, causing long delays and wrong capital blockages. The budget extends provisional refund rules to inverted duty structure cases as well. Overall, the intent is to make the refund system more supportive of genuine business requirement. Next, the amendments to refund on export with payment of tax. There is also a positive changes for exporters, especially for smaller ones. Earlier, refund on export with payment of tax was subject to minimum threshold limit of 1,000, which disadvantages for small exporters. The budget removes this threshold entirely. It caused the benefit to small exporters can claim their refund. Now, eligibility for export benefit no longer depends on the volume of exports. Finally, let me touch upon a custom reforms. The Union Budget 26-27 proposes comprehensive reforms in customs and central exercise to simplify the tariff structures and ease compliance. The measure focus on trade facilitation, export competitiveness, correction of duty inversion, and strengthening a trust-based custom administration while improving the ease of living. Firstly, let us look upon the reforms introduced on import for personal purposes. Rationalization of import duty on personal goods. To reduce the cost burden on individual custom duties on personal imports, it's proposed to reduce from 20% to 10%. This rationalization simplifies the duty framework and enhances affordability while reducing disputes. Passengers-friendly baggage reforms. The budget proposes a revision of baggage clearance rules for international travelers to enhance duty-free allowance and clarify temporary import and export of goods. This changes aims to address long-standing passengers' concerns and minimize delay at airports. Relief for patients and rare diseases. Basic custom duties exemption is proposed for 17 specified drugs and medicines, including those used for cancer treatment. 7 additional rare diseases have been included under the national policy for rare disease to allow duty-free personal import of essential medical product. Now, let us look upon a reform introduced on import for commercial purposes. Faster clearance through digital process. Regular and compliant importers will be recognized under the risk management system to reduce repetitive cargo checks. Export cargo using electronic seal will be permitted direct clearance from factory premises to ports, enabling faster movement of goods. Overall of customer warehousing framework, the custom warehousing regime will transition to warehouse operator-centric model based on self-declaration, electronic tracking, and risk-based audits. This shift the reduce officer depends approval, lower compliance cost, and improve operational efficiency. To summarize the part of indirect taxation in this budget, focus on correcting long-standing GST distortion, aligning tax law with commercial reality, improving cash flows through faster refunds, and making customs more citizen and trade friendly. Overall, it's a business positive and litigation reducing budget. Now, moving to a thanks note, our senior partner will take on.
Good evening. Every budget brings a lot of changes. So the key is we should adapt it early and strategically. And we are always committed to guide you through. So we really thank everyone taking your time off and attending this presentation. All your queries, we'll address it offline. And once again, thank you for taking part and sparing time to attend this presentation. Thank you all.